Financial markets around the globe witnessed an extraordinary event on January 30th, 2026. Silver, the precious metal known for its industrial applications and investment appeal, experienced a collapse of historic proportions. The metal plummeted 30% in a single trading session. This decline represents the most severe drop recorded since 1980. That year, a group of investors known as the Hunt Brothers attempted to control the silver market through aggressive buying strategies. The collapse follows a remarkable period of growth for silver. Over the previous 12 months, prices had surged by nearly 250%. The rally attracted significant attention from investors, traders, and market analysts. The metal reached levels that prompted warnings from several prominent figures in the financial industry. These warnings, issued in the days and weeks leading up to the crash, proved accurate. The sudden reversal has now created a new dynamic in precious metals markets. Two analysts who correctly predicted the downturn have returned to public forums with a surprising message. Peter Brandt, a futures trading professional with decades of experience, and Marko Kolanovic, a former strategist at a major Wall Street bank, both issued bearish forecasts before the decline. They anticipated a significant move lower after silver reached what they described as a parabolic top. A parabolic top refers to a price pattern where an asset rises sharply in a short period, often followed by a steep decline. Following the 30% drop they anticipated, both analysts have altered their short-term outlook. They are now expressing a more optimistic view for the immediate future. This tactical shift from bearish to bullish reflects the dramatic nature of silver's price movements. The change in perspective demonstrates how quickly market conditions can evolve in an environment characterized by extreme volatility. The volatility in silver markets has reached extraordinary levels. Price swings of this magnitude create both risks and opportunities for various market participants. Traders who employ short-term strategies may find conditions suitable for profit. Long-term investors face decisions about whether to maintain positions or adjust their holdings. The current environment presents challenges for both groups. Market observers with extensive experience have noted the unusual nature of recent price action. One analyst, who has tracked financial markets for more than 3 decades, documented the bearish warnings from Brandt and Kolanovic in advance of the decline. The analyst noted that both professionals expected a major downward move following silver's rapid ascent. Their forecasts were based on technical patterns and market dynamics observed over many years of trading and analysis. Peter Brandt brings 5 decades of commodities trading experience to his market analysis. His career began in 1976 with Conti Commodity Services, which operated as a division of Continental Grain Company. Over the course of 50 years, Brandt has observed numerous commodity cycles. He has developed a reputation for identifying major turning points in markets. His warnings about silver were based partly on comparisons to a previous peak in 2011, which he also successfully predicted. Marko Kolanovic has built a distinguished career spanning more than 20 years in financial markets. He held positions at Merrill Lynch and Bear Stearns before beginning a 16-year tenure at J.P. Morgan. His work at J.P. Morgan earned him induction into the Institutional Investor Hall of Fame. This recognition represents one of the highest honors in the financial analysis profession. Before the recent decline, Kolanovic issued a stark warning. He predicted that silver could face a reckoning of 50% in the coming year. This forecast suggested that prices could ultimately fall by half from their peak levels. Both Brandt and Kolanovic shared direct warnings about silver's rally in the paper market. The paper market refers to futures contracts and other financial instruments that represent silver without involving physical metal. This distinction between paper and physical silver would become increasingly important as events unfolded. The warnings from these two respected professionals highlighted concerns about the sustainability of silver's rapid price appreciation. The 30% single-day decline validated their cautious stance. However, the magnitude of the drop also prompted both analysts to reassess the near-term outlook. In markets characterized by extreme volatility, prices can overshoot in both directions. A decline that begins as a correction can become excessive, creating conditions for a rebound. This dynamic appears to be influencing the current thinking of both Brandt and Kolanovic. Following the dramatic sell-off, Kolanovic made his revised view known through social media. He acknowledged his previous bearish stance, but noted that a 16% drop in a single day represents a significant move. The actual decline exceeded even this figure, reaching 30%. Kolanovic suggested that the metal might experience a bounce following such a steep fall. His comment reflected recognition that markets often experience short-term reversals after extreme moves. Brandt also adopted a more constructive near-term view while maintaining caution about the longer-term picture. He stated that silver would probably rally from the low point reached on January 30th. However, he made clear that this potential bounce would likely prove temporary. Brandt believes that additional downside may lie ahead before silver can establish a durable foundation for sustained gains. He suggested that speculative investors, whom he characterized as overconfident participants, would need to be thoroughly removed from the market before a lasting upward move could begin. Brandt drew an important distinction between the current situation and the peak reached in 2011. Following the 2011 high, silver eventually declined back to price levels in the teens per ounce. The rally leading to that peak was driven primarily by investment speculation rather than fundamental supply and demand factors. Brandt believes the current cycle differs in important ways. He expects that silver has more potential for gains over the longer term. However, he thinks this upside may not materialize until later in 2026 or even early 2027. The shifting views of these two prominent analysts underscore the extreme volatility currently characterizing silver markets. Their tactical move from bearish to bullish for the short term, while maintaining caution about the intermediate period, reflects the complexity of the current environment. Market participants must navigate conflicting signals and rapidly changing conditions. The dramatic price movements in silver stem from multiple factors. One critical element involves the relationship between paper and physical silver markets. For many years, prices were primarily determined by trading in futures contracts. These contracts represent agreements to buy or sell silver at a future date. Most futures contracts are settled in cash, rather than through delivery of physical metal. This system allowed financial institutions to exert significant influence over silver prices through large positions in the paper market. Recent developments have disrupted this traditional market structure. In 2026, China implemented restrictions on silver exports. These restrictions created supply challenges for companies in various industries. Silver serves essential functions in next-generation solar technology and artificial intelligence applications. As these sectors continue to expand, demand for physical silver has intensified. Companies that need actual metal for manufacturing purposes are no longer willing to accept cash settlements in lieu of physical delivery. The market has experienced 6 consecutive years of supply deficits. Production of newly mined silver and recycled material has not kept pace with consumption. In this environment, industrial buyers have become increasingly insistent on obtaining physical metal rather than paper claims. This shift in behavior has created intense pressure on the warehouses operated by major commodity exchanges. Inventories at the COMEX exchange and the London Bullion Market Association have declined to their lowest levels in decades. The strain on physical supplies has created an unusual market condition known as backwardation. In normal market conditions, futures contracts for delivery in future months trade at higher prices than contracts for immediate delivery. This reflects the costs of storage and financing. In backwardation, this relationship inverts. Silver available for immediate delivery becomes more valuable than promises of future delivery. This situation indicates acute shortages of physical metal. Data from financial information providers reveals the scale of the disconnect between paper and physical markets. According to information from investing.com, the paper-to-physical ratio has reached extraordinary levels. There are 528 million ounces of paper-silver exposure compared to just 113 million ounces of physical silver available. This ratio demonstrates the extent to which paper claims exceed available metal. The disconnect between paper and physical markets represents a fundamental structural issue. Industrial buyers require actual silver to manufacture their products. They cannot substitute paper claims for the metal needed in production processes. As artificial intelligence technology advances, demand from this sector is creating structural imbalances. Companies involved in AI development and deployment need silver for various components and applications. This demand is contributing to persistent shortages of physical metal. When silver prices crashed by 30% on January 30th, the decline did not reflect a collapse in underlying demand. Instead, the drop resulted from forced selling by leveraged speculators in the futures market. These speculators had built large positions using borrowed money. When prices began to fall, they faced margin calls requiring additional funds to maintain their positions. Unable to meet these requirements, many were forced to sell, accelerating the decline. The CME Group, which operates major commodity exchanges, had implemented changes to margin requirements in January 2026. The exchange moved to a percentage-based margin system. Maintenance margins increased to 15% for standard positions. For positions deemed to carry heightened risk, margins rose as high as 16.5%. These changes effectively ended an era of inexpensive speculation in paper silver. Previously, traders could control contracts representing 5,000 ounces of silver with minimal collateral. The margin requirement changes created what has been described as a margin trap. The new rules aim to prevent a potential clearinghouse collapse as silver prices surged toward $120 per ounce. The measures accelerated forced liquidation when prices began to fall. Highly leveraged speculators who had exhausted their available capital had no choice but to exit their positions. Many had become overextended during the rally and lacked resources to meet the new margin requirements. This type of regulatory intervention has historical precedent in silver markets. In 1980, when the Hunt brothers attempted to corner the silver market, regulators eventually broke their position by raising margin requirements. The increased capital demands made it impossible for the Hunt brothers to maintain their massive holdings. The market collapsed, and silver prices plummeted. The recent margin changes by the CME Group employed similar logic, though the circumstances differed in many respects. While futures markets displayed red on trading screens, physical silver markets told a different story. Premiums for physical metal in Shanghai and Dubai actually increased during the paper market decline. Physical silver in these markets traded as much as $20 per ounce above Western spot prices. This divergence illustrated the fundamental disconnect between paper and physical markets. Buyers seeking actual metal were willing to pay substantial premiums above the official futures price. Looking ahead, market observers expect continued volatility in silver. The conditions that created recent extreme price movements remain largely in place. The paper-physical disconnect persists. Industrial demand continues to grow. Mining companies face challenges in increasing production. These factors suggest that silver markets will remain unstable for the foreseeable future. Supply constraints represent a significant ongoing issue. Even as some mining companies attempt to bring new production online, overall supply is likely to remain limited throughout 2026. The nature of mining operations makes rapid supply increases difficult to achieve. Developing new mines or expanding existing operations requires years of planning, permitting, and capital investment. Short-term supply responses to higher prices remain constrained by these realities. Major silver mining companies have provided guidance suggesting continued tight supply conditions. Fresnillo, identified as the largest global silver producer, reduced its production guidance for 2026. On January 28th, the company lowered its forecast to a range of 42 to 46.5 million ounces. This compares to a previous forecast of 45 to 51 million ounces. The chief executive officer cited operational phasing and a shift to narrower, lower-grade veins as reasons for the reduction. These challenges highlight the difficulties mining companies face in responding to strong demand. Hecla Mining, another significant producer, announced plans for production of 15.1 to 16.5 million ounces in 2026. This represents a decline from production levels achieved in 2025. The company faces its own operational challenges that limit its ability to increase output in response to high prices. Some production increases are expected from certain operations. Silverstorm Mining plans to restart idled production at the La Parrilla facility in Mexico during the next quarter. This operation includes a mill capable of processing 2,000 tons of ore per day. Pan American Silver expects increased production from its Cerro Moro operation in the second half of 2026. The company has provided guidance indicating total silver production of 25 to 27 million ounces for the year. This would represent an increase from approximately 22.8 million ounces produced in 2025. While these production increases will add to available supply, they must be weighed against the substantial demand from industrial users and investors. The overall supply-demand balance is expected to remain tight. This situation will likely continue to support elevated price levels and high volatility in silver markets. The outlook for silver prices depends on several key variables. Economic growth drives industrial demand. A significant economic slowdown could reduce consumption from manufacturing sectors. However, the specific demand from solar and artificial intelligence applications may prove more resilient than traditional industrial uses. These sectors represent growth areas where silver consumption is expected to continue increasing regardless of broader economic conditions. Mining supply responses will gradually influence the market over time. However, the lag between price signals and meaningful production limits the near-term impact of supply adjustments. Regulatory factors also play a role. Margin requirements and other exchange rules affect the behavior of speculative traders in paper markets. Physical market dynamics depend on export restrictions, transportation logistics, and regional demand patterns. The current situation in silver markets represents a complex interplay of financial and physical factors. Paper markets remain subject to speculation and leverage. Physical markets reflect genuine supply constraints and industrial requirements. The tension between these two aspects of the market creates conditions for continued dramatic price movements. Participants in silver markets must navigate an environment characterized by unprecedented volatility and structural imbalances that show no signs of immediate resolution.